91, 92, 93, 94, 95, 96, 97, 98, 99, 100, 100.
That's right, we've made it. Today marks our 100th episode of The Income Generation. That is 100 episodes aimed at sharing what you really need to know to protect your money in today's challenging financial environment. Now, we're going to celebrate today with a new show focusing on the top 10 steps to prepare you for retirement. It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. I'm David Scranton. You know, in some ways it feels like it was just yesterday that we launched our first episode of The Income Generation. And in other ways, it seems like we've been doing this for decades. That's how it is with any project where you work hard and you feel passionate about it. And I'm still extremely passionate about this for this reason. The financial challenges faced by investors over the age of 50 are as great today as they were 100 episodes ago. If anything, they've actually gotten worse, with new records of stock market volatility and economic uncertainty around the world. But relax, you're in the right place. And on today's show, we're going to recap some of the key messages we've shared about creating a financial plan that works regardless of market conditions. Plus, we're going to identify our top 10 steps to preparing for retirement. And joining us will be Peter Cheer, the head of macro strategy at Academy Securities, along with Anthony Siccaro, founder and president of Providence Financial and Insurance Services. But first, let's take a few minutes to recap what the income generation is all about. Now, if you're a regular viewer, or even if you watch just a few episodes of the income generation, you probably have a good handle on our mission here. In a nutshell, our goal is to provide information that helps you create a retirement plan that's right for today's financial challenges, many of which are unique to this generation of retirees and near retirees. Your parents and grandparents had their own unique challenges, for sure, but many of them also had pension plans and affordable health care. They didn't have to prepare for up to 30 years of retirement income and weren't part of the so-called sandwich generation with financial obligations to both grown children as well as aging parents. They hadn't lived through two devastating stock market crashes and the ongoing threat of a third in their prime years of saving for retirement. And again, our parents and grandparents definitely had their own challenges. But the issues that I just mentioned, along with several others, are in many ways unique to the baby boomer generation as we prepare for retirement. With that in mind, it stands to reason that many conventional ideas and supposed truisms about saving and investing have become outdated. They're obsolete for our generation. Why? Because they simply don't address a lot of the specific challenges that we face. So when I talk about a plan right for today's financial challenges, I'm talking about a plan that focuses primarily on two things. One, protecting our savings from the dangers of loss as well as spend down in today's new age of economic and market uncertainty. And two, generating a reliable income stream to meet today's challenges, to achieve your personal retirement goals, and to provide the opportunity to grow your savings organically through what we call strategic reinvestment. Less risk and reliable income. Basically, that's our focus here on the income generation. And if you're a regular viewer, you know it's been my focus as a financial advisor since the 1990s. That's when I foresaw the bursting of the dot-com bubble and the first major sustained market correction of the new century. I recognized that crash from 2000 to 2002 as just the beginning of a prolonged period of market turmoil and a prolonged period of uncertainty that would last 20 to 25 years or maybe even more. In other words, a new long-term secular bear market cycle. Now, unfortunately, most advisors didn't make that same analysis. They didn't foresee the onset of this new secular bear cycle or of the second major correction that occurred subsequently from 2007 to 2009. And as a result, most did not adapt, or they didn't make any changes. They kept following the same old Wall Street-based business models. They kept recommending the same outdated, obsolete textbook rules and strategies for their clients. And most investors followed their recommendations. Why? Because they didn't realize that there was an alternative. And because, like many advisors, a lot of investors became addicted to the stock market in the 1980s and 1990s, the best long-term secular bull market that this country has ever seen. However, in the last 10 years, I, as well as a growing number of advisors across the country, have made it our mission to educate investors of our own generation that there is, in fact, an alternative, a strategic approach that addresses the challenges unique to this generation of retirees and near retirees. And that generation is the income generation. But in addition to our collective challenges, every individual has also his or her own unique challenges when it comes to retirement planning. And that's why it's so incredibly important to identify your specific retirement goals and to properly manage two important issues that every retiree must deal with: Social Security and required minimum distributions. We'll talk more about the two of those in just a minute. But now it's time to welcome our first guest, Peter Chur. He's the head of macro strategy at Academy Securities. Peter has an extensive background as a structurer and trader at large banks and hedge funds. He's also a regular on networks like CNBC and Bloomberg TV. Peter, welcome back to the show.
Thanks again for having me.
You know, we were talking off the air for just a minute about debt. One of our top 10 things, of course, actually number one. And that's a big thing of yours. Do you want to talk to our income generation viewers for just a minute about why controlling debt on your way into retirement you think is so incredibly important?
Yeah, I think people spend a little bit too much time thinking about what dividend yield they're going to get, what interest rate they can get on what mutual fund, and they don't spend enough time on their debt. So one, I completely agree that paying it down is good, but people should also be looking for opportunities to refinance. A couple years ago, you could have locked in much lower mortgage rates if you had a mortgage. You should have done that. It kind of moved away. It might be coming again. So I would not ignore kind of what I call the liability side of your balance sheet. So where you own debt, not just looking at repaying it, which I think is brilliant, but even if you can't repay it, are there times to refinance? Are there ways to manage that better? And that will help your overall income because you care about the bottom line, not just the income side of your statement.
So in a word, it sounds like most people are focused more on offense than defense. They focus on growing their net worth than they do on reducing their expenses. But isn't that kind of sort of what the federal government's doing right now? You know, this whole thing, doesn't matter how much debt we have, we can grow ourselves out of the debt. We can grow our way out of it as long as we get 4% GDP growth. So in some ways, isn't the federal government teaching this bad habit to our viewers?
Yeah, we, I think, are definitely learning bad habits from our own government. It's a little bit scary how blasé they've become about the amount of debt they're taking on. So when I go and talk to large corporations, 2 years ago, really people weren't talking about the federal deficit. It was viewed as temporary, that it was getting under control. That is now a regular question. What are we going to do with these trillions of dollars of debt that are expanding rapidly? Interest rates are rising. I don't see it as being a big problem for investors yet, but this is something, if we don't start gaining control, I think it's going to, you run that risk of kind of spiraling out of control where our own debt problem is an issue. And it's so weird because we are looking at Europe, who's gone this method of austerity and is getting their debt situation under control, and they're looking at us wondering what the heck are we doing taking on so much debt, and it's unclear that we're getting enough benefit from it or that we're using that debt wisely. It's not like we were in the middle of a recession. We took on a lot of this additional debt where times were generally good. That could punish us down the road. It's not an issue today for me or for next year, but it's something we've got to keep in mind if we keep heading down that path.
Yeah, the whole government shutdown, I wasn't necessarily opposed to it. I was just questioning the reason. To me, it's not about the wall. To me, the government shutdown should be more about getting the budget balanced, that we can't keep spending. We reopen when we get everything balanced and figured out. But I guess my question I'd like to ask you, though, is what happens if they don't figure it out? What happens if the debt keeps growing and growing and growing? Could we, right now we have the privilege of being the world's reserve currency, oil being traded in dollars. What happens if something changes there? Could we become the next Greece, essentially?
I don't know that we can become the next Greece, but I think we could become the next UK or England, which really is no longer a leader. And that happens for a couple reasons. One is when I look at DC, their idea of compromise is you get to spend what you want and I get to spend what I want, so we both get to spend. And that's been going on and on. Every time we hit a debt ceiling or some need to compromise, both sides get it. And I think we've created a system where everyone's incentivized to spend, try and get as many votes as they can and stay in power. And that's created it. And just like you said, the dollar as a reserve currency is important. They have now started trading, though, in China, oil in renminbi. So China is starting to get global commodities traded in their own currency. I think it's a mistake that we are pulling back from the global stage too quickly. We're letting places like Venezuela into the hands of India, most of Africa into the hands of China. We're pulling back. As we lose that reserve currency status, I think there's going to be a lot of impacts to us, and it's not going to be healthy.
So 30 seconds we have left in this segment. Why can't we become the next Greece if we lose our status as the world reserve currency? Worst case, why couldn't it happen?
Because right now, still so much of the debt is owned domestically. So I think if we could get some inflation, we would look probably much more like a Italy or Spain, which isn't necessarily great, but it's a long way from being Greece. So I think that's what we have. We've got much more protection. And then the other thing, again, we always talk about both sides of the balance sheet. We do have a lot of debt. We have a lot of assets that have not been unlocked, that are national assets, that things can be done to do that. So again, I don't think we have to be alarmist, but we have to start being careful.
Got it. Peter, stick around. We'll be back in just a minute. And you stay with us, too. We'll be back with more here on The Income Generation. I'm David Scranton. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
There are many, many differences in the factors that individuals must consider and account for when creating their own financial strategy. That's why advisors who specialize in income-based strategies take a very personal approach. There's simply no one model that's right for everyone, no cookie-cutter approach or computer algorithm used to help you make investment choices. It's all about you and your individual goals and circumstances. Now that said, there are some basic issues that every retiree does have in common, which is why I like to base a lot of my introductory educating about investing for income around those issues. And one of them, of course, is, yes, Social Security. In a way, Social Security is like the cornerstone of the investing for income model. Why? Because it's a perfect example of what we're working to achieve more broadly, a secure and reliable income stream that you simply cannot outlive. Now, for most people, Social Security will be one of the largest items on your balance sheet, especially if you start taking your benefits at just the right time. When that time is depends again on your personal goals and circumstances. But it is one of the most important decisions you have to make about retirement. So it might be one that you want to make with the help of a qualified financial professional. Now, as I pointed out before on the show, The difference oftentimes between the number one best method and the second best method of taking Social Security in your particular situation could mean as much as an extra $100,000 or more in benefits over the course of a lifetime. And that is fact. It's also a well-known fact that for most people, Social Security alone simply won't be enough to live on during retirement. Most people will need to supplement it, of course, with other sources of income. And how you do that is just as important to achieving your retirement goals as is the overall size of the portfolio itself. In other words, successful retirement planning isn't just about how much money you have at retirement, but about how you manage it to meet your retirement income needs. Now, that may sound obvious, okay, but it's amazing how many people fall into the dangerous mindset of thinking, gosh, I've got plenty. And as a result, they get complacent and or they make mistakes. Why? Because they think that the amount of money they have is by itself enough to ensure that they won't run out. And they end up many times being wrong. I've seen it more times than I can count, and it often happens because those individuals haven't, or their advisor hasn't, taken all the relevant factors and contingencies into account, including those many challenges that are unique to our generation. Things like longevity rates, and the fact that today's retirees need to prepare for 30 years of income generation or more, plus inflation. Things like healthcare costs that basically double every 12 years. And of course, the new complexities and uncertainties of the financial markets, and the fact that we're still in a high-risk, I believe, long-term secular bear market cycle. In short, your asset allocation is just as important as the totality of your assets. You want to be sure that you're allocated in a way that helps you avoid spending down your retirement savings in the event of a medical emergency or any other emergency for that matter. Or from doing the same thing when it comes time to address that other issue besides Social Security that almost every retiree will have to contend with at some point, and that is taking your required minimum distributions, your RMDs. These, as you may know, kick in after you reach the age of 70 and a half. See, the IRS mandates that you start taking withdrawals from your IRAs and 401ks and those types of accounts and begin to pay taxes on them, again, starting at age 70 and a half. Ideally, a portfolio with the right asset allocation should be able to generate enough return through just interest and dividends to satisfy these required minimum distributions without forcing you to take any of your principal at all. And as I often explain on the show, total return on investment is a sum of both growth and income, with growth, of course, coming in the form of capital appreciation and income in the form of interest and dividends. Now, if your interest and dividend income isn't quite enough to cover your RMDs, then you'll most likely end up having to take those RMDs from principal, in which case you're depending upon growth or capital appreciation to occur in your portfolio every single year to cover those government-forced distributions. The problem is that your portfolio doesn't grow every single year, and that in a down market, growth turns into shrinkage. And when that happens, it doesn't take long to start cannibalizing your retirement account, which is actually one of the most common and costly mistakes that retirees can make with their money today. How do you avoid it? How do you avoid all the other common mistakes surrounding this topic? Well, we'll talk more about that as I share our top 10 steps to preparing for your retirement coming up in just a bit. Right now, let's welcome back Peter Chur, Head of Macro Strategy at Academy Securities. Peter, thanks for sticking around. You know,
Thanks for having me still around.
You mentioned Italy and some other countries like that. You know, it always amazed me how the Federal Reserve expected our long-term bond yields, our 10-year Treasury rate, to keep going up when our 10-year Treasury rate was already paying more interest than the rate on a 10-year Italian bond, which arguably has a lot more default risk than ours. As you know, the bond market just put its foot down in December and refused to cooperate. And finally, just this last week, Jerome Powell came out with that more dovish tone. And it's possible now that instead of raising rates 3 or 4 times this year, he may not raise rates at all. So is this too little, too late to keep the economy going, to fend off that next recession? Is it too little, too late to to fend off the bear market? Or do you think that he came up with this announcement just in the nick of time?
I think he's a little bit late. We really think that they should have started hiking rates much earlier than they did, but much slower. The things that scare me when I look at the impact of rate hikes is things like automobile sales have slowed, and that's dependent on financing. Homes have slowed. So I think they went way too quickly. I think you're supposed to wait 6 to 9 months between a rate hike to make sure that the economy is doing okay. People argue rates are still low, but it's that rate of change that's important. So I think they went too fast. They're shrinking the balance sheet. This is a good pause. They should have started doing this back in September. We've got to see whether collateral damage is done or not. The two things that can help us is getting the government shutdown properly solved would help a lot, and a trade deal with China. If we can get that accomplished, that puts some of this fears behind us, right? If we get a trade deal, we don't have to worry so much about the level of rates. Without that, though, I do think they went too far, too fast, and we're experiencing those problems. So they've got to ease off the brakes, and he finally did what he should have done several months ago.
Yeah, we didn't have time to digest the rate increases, what it comes down to. And, you know, the Italians know best. When they have that big meal on a Sunday afternoon, it might be 8 courses, but it's over the course of 6 hours. It gives you time to digest each course, and unfortunately, the Federal Reserve didn't get us to do that. So 20
That's
seconds.
a great way of looking at it.
20 seconds. Recession. We're overdue for a recession. Do you think we see it at the end of this year? Do you think we see it next year? Or do you think we see it 2021 and beyond?
I think it's beyond that. I think we are going to get the government shutdown resolved, which will help a lot of things. Then I do expect a trade deal with China. It's in China's interest to give us a trade deal. We want it. It will help businesses like liquid natural gas, where we can now export that, where we're a great producer of that. So I don't think we really see a recession. We see continued growth, but different sectors are going to lead the way for the next 2 or 3 years. So I'm actually optimistic, but a lot hinges on getting those trade deals.
15 seconds then. How does that leave the stock market? Will the stock market be able to rebound and break new record highs in light of this, or has it gone up so much that, again, that needs time to digest what's happened?
No, I think the stock market can do well. And one thing I really like is companies are starting to pay attention to the debt they've created. So some of the companies like GE, Budweiser, Newell Rubbermaid, household names where the stock had beaten down because they had too much debt, are taking care of the debt and the stocks are rebounding. That to me is healthy and more sustainable.
Got it. Okay, I love the optimism. I hope you're right. Peter, thanks so much for joining us. Stick with us. We'll be right back with more here on The Income Generation. I'm David Scranton. We'll be right back.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes. David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model. Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
Remember the book of lists? It was a huge bestseller back in the day. And if the internet has proven anything, it's that people continue to love lists. With that in mind, I'd now like to share a new list that we've compiled covering the top 10 steps to preparing for retirement. First, though, an important disclaimer from our legal team. One of the reasons people love lists is that they sometimes help condense and simplify information. They boil things down to the bare essentials, and that's exactly what this list is intended to do. But it is by no means meant to be a guide to retirement planning. Okay, now that we're past all that, as we've been discussing all day, there are so many factors and challenges to consider in retirement planning that the best way to approach it for most people is in partnership with a qualified financial professional. Ideally, someone who specializes in retirement income. As we talk about this all the time, but the right advisor can help you not only address the key items on our list, but also identify other important issues. So with that in mind, let's run down our top 10 steps to preparing for retirement. Number 1, eliminate as much debt as possible before you retire. While some debt is fine, studies show that carrying too much debt into retirement and accumulating more debt during retirement can be major problems for many Americans. Number 2, identify your specific retirement goals. And when I say specific, I mean just that. Do you plan to move or do some traveling? And if so, where to? Will you be spending more time on your favorite hobbies and activities? And if so, which ones? How much time? How much will they cost? Identify your goals and be as precise as possible. Number 3, do a top-down budget analysis to determine how much lump sum savings you'll need for retirement when factoring in your specific goals. Remember, a top-down analysis involves calculating all the expenses that will go away after you retire. Things like the FICA tax and possibly mortgage payments if your mortgage will be paid off right before retirement. Number 4, calculate Social Security income based on taking benefits at the optimal time. Now, as I discussed earlier, determining the optimal time is something the right advisor can help you do based upon your age, your earnings, your goals, and many other factors. Number 5, reduce your stock market risk by making the strategic shift from focusing on portfolio growth to focusing on retirement income. That's a big one in today's uncertain market, so much so that we created an entire show about it. Number 6, make sure your asset allocation is right for RMDs. As we discussed earlier, that means an allocation that enables you to satisfy required minimum distributions from interest and dividends without the risk of cannibalizing your principal. Number 7, estimate your long-term healthcare expenses and create a strategy for meeting them. This can be challenging, but keep in mind that medical and healthcare costs increase at a much faster and steeper rate than the general rate of inflation. Number 8, create an estate plan with the help of a qualified estate planning attorney. No matter what your level of wealth is, an estate plan is crucial for many reasons, including minimizing taxes, avoiding probate, and ensuring that your assets are protected under law. Number 9, create a retirement lifestyle plan, one that will help ensure that you enjoy good physical, good mental, and good emotional and spiritual health after retirement. As we've discussed on our recent show about aging gracefully, secure savings and reliable income mean little if you don't have the health and the quality of life to enjoy these things. And last but not least, number 10, of course, is find the right financial advisor with whom you can work. And work with that person to address not just the items on our list, but all the other factors that you need to consider to meet your goals and to enjoy the kind of retirement that you deserve. Now it's time to welcome our next guest, Anthony Siccaro. Anthony is the founder and president of Providence Financial Insurance Services in Woodland Hills, California. He's been in the business for approximately 20 years and has twice been named one of California's top financial leaders by Forbes magazine. Anthony is a widely published author and a frequent guest on Fox Business News, CNBC, and other financial media outlets. He's also a good friend of the income generation and, more importantly, a very close friend to yours truly. Anthony, thanks for being here in studio with us today.
David, thank you for having me.
You've come almost 3,000 miles to be here with us on the income generation, and we appreciate that. I want to talk to you grassroots as a guy who's got boots on the ground with those top 10 things. Okay, now Peter Chur, as you heard, talked a little bit about the debt reduction. So I don't want to talk to you about debt reduction. Why don't you start by talking to our income generation members about goals, why it's so important to figure out your specific individual retirement goals, what they mean to you and how they might look and how much they might cost.
Yeah. I think one of the biggest mistakes that retirees make is they don't set a goal. And the challenge is if you don't set a goal, then how do you know if your particular strategies are conflicting with or supporting that goal? Yeah. And that's really the issue, is if you don't know where you're going, if you don't put the target, then you don't know if you hit the target.
Right.
And I think there's several areas. I think there has to be a debt elimination goal. Hopefully you get into retirement and as your earlier guest said, hopefully you're debt free by the time you get there. I think you need to have a lifestyle goal. I think you need to know specifically what kind of life you want to live in retirement. And then you have to have an investment goal to make sure that you are investing to support the lifestyle you want. And then you have to have a legacy goal. What do you want to happen? Because we know that we're all going to pass at some point.
So lifestyle goal. What are some of those common lifestyle goals? For some of us that are a few years out of retirement that are watching the show, they're saying, well, I don't know what retirement's going to look like. I don't know. I'll just keep doing what I've always done. Except you're not, because you're not going to be going to work anymore. What are some of those common lifestyle goals that you see our income generation members desiring as they approach retirement?
Yeah, interestingly enough, you've got the fun lifestyle goals like see the grandkids and do the traveling and the cruises and stuff like that. But the reality is with regards to lifestyle, there's one common thread that every retiree wants with their lifestyle, and that is not to have to worry about running out of money at the end of it. And the challenge is no matter what you want to do in your retirement, whether it is traveling or spending time with the grandkids or golfing, the reality is, David, is that it's going to take income to do that. Mm-hmm. And you must have the goal of knowing how you want your retirement to be so that you can know if you're getting enough income to support it. And most people are not getting enough income from Social Security and their pensions. Most people have to supplement those sources of income through their portfolios. And it's been a big problem that we've seen that people have that have not done that.
Well, it's like we always talk about in this television show. We talk about going from the G to the I, going from growth to income, or going from the accumulation years to the distribution years. That's the only way you can be sure that you don't run out of money. So, in the 50 seconds we have left in this segment, tell our income generation viewers then, why it's so important to go from the G to the I as you approach retirement.
Yeah, this is probably the biggest mistake that I see people make, and that is there's a different strategy when you're in the growth phase of life as opposed to when you are in the income phase of life. The reason is when you are in the growth phase of life, if you want to start getting cash out of your portfolio because you have to because of required minimum distributions, or because you want to because you actually want to spend some money and do some things in retirement, then what you have to do is you have to sell shares to get the income you need. And that means cannibalizing your portfolio. And if you live long enough, you're going to be out of money. Well, as the income generation is shared for the years that it's been on, if you invest for dividends and interest and you can live off the interest or dividends without selling shares, you'll protect your principal along the way.
And that's what it's all about. Perfect. We need to take a commercial break. We'll be right back here with more on the income generation. Stick with us. We'll be back with Anthony Siccaro and David Scranton. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
For 100 episodes now, I've been introducing this show the exact same way. It's time once again to tune out the hype and focus on the facts. Facts that matter to you, the income generation. We came up with that intro because it makes an important point about how the show is different and how we wanted it to be different. You don't need me to tell you there are plenty of other programs and pundits out there offering their own advice and guidance about the best ways for boomers to save and invest for retirement. But unfortunately, what a lot of these programs and pundits are really sharing isn't really so much information as it is Wall Street's party line. Now, just as most advisors didn't alter their Wall Street-based business models when the market started shifting back in the late 90s, additionally, most financial media didn't change either. Most outlets continued and continue to this day to stress conventional and now outdated financial strategies that fail to meet the unique needs and challenges of today's generation, that generation of retirees and near retirees, our generation, the income generation. And as a result, I believe so much of the so-called information they provide amounts to little more than hype. A lot of it comes down to one big marketing pitch designed to further the myth that the stock market's the only game in town for investors seeking decent returns. For a variety of reasons that I've discussed on other shows, they're acting as little more than Wall Street cheerleaders and conveniently ignoring a lot of facts that might run counter to their pro-stock market cheers. Facts like some of those I've shared on today's show. The fact that total return is a sum of both growth plus income, for instance, and that investors can achieve return rates equal to or better than stock market returns with sometimes less risk by focusing on the income component instead of the growth component. Or the fact that the long-term secular bear market cycle that began in the year 2000 likely has at least one more major sustained correction to go, a drop that history dictates must range somewhere between 40 and 70%. Or the fact that the reason many advisors recommend bond mutual funds instead of individual bonds is simply that they're not qualified to manage a diversified portfolio of individual bonds to achieve those competitive rates of return. Doing that takes an advisor who specializes in income-based financial strategies. And that's another fact, not hype, that you'll only hear right here on the Income Generation. And now it's time to bring back our good friend Anthony Siccaro, founder and president of Providence Financial and Insurance Services. Anthony, thanks again for sticking around.
Thank you for having me. I love being here.
So we talked about asset allocation, the need to make that change to income from the G to the I. When should people start making that allocation that allocation change as they prepare for retirement?
Yeah, good question. So I think it depends on where we are in the economic cycle because ironically, investing for the I, for the income, is actually more conservative and really safer than investing for the G.
Of course it is.
Sometimes people think that, oh, I'm only 5 years away from retirement, so I've got 5 more years of growth. Well, that's really not true if the market goes down for the next 2 or 3 years, as you know from watching this show, and as I believe is very likely. So if you're in retirement and you need to start getting income from your portfolio, certainly you have to invest for that stage appropriately. Or if you're within maybe 5 or so years of retirement, I think it's time to start focusing on principal protection. And instead of just socking it in the bank and earning 0, at least you're getting 4, 5, 6% along the way through dividends and interest.
So now with the market being high, it might be a good time to consider, hey, even if I'm a little more than 5 years out, maybe I should start considering lowering that stock market exposure anyways, going from the G to the I. But you're saying even if the market looks more opportune, if it's lower, you think there's more growth potential, still, 5 years is like the drop dead date. By the time you're 5 years out, you really need to start making that transition, correct?
Oh, 100% correct. I mean, you go any longer than that, and you're really in danger of having your portfolio be at a lower value. And now when you retire, you start having to sell shares of the investments that you have, and that's when you don't want to sell shares.
Yeah, you have to sell shares, or you have to go back to work, or you have to live on less income. And none of my clients and none of your clients want to do either of those things. Okay. So let's pivot for a second. I want to talk to you about the long-term care aspect. How important is it to focus on the long-term care portion, the expenses, and tell us about that.
Yeah, I think it's absolutely huge. The reality is that long-term care right now is going to cost you about $100,000, especially in California, where I'm from. And if you want it to be done at home, it could cost you $150,000 or even more, $175,000 a year. The challenge is coming up with that type of money, and a lot of people don't have insurance for it because it's just super, super expensive. But there's actually something out there called asset-backed insurance, where they've actually combined life insurance with long-term care insurance, so that if you need long-term care insurance, then what winds up happening is it will cover you. But if you don't ever use it, like we don't want, and you wind up passing away, a big death benefit goes to your beneficiaries.
So instead of trying to pay $5,000 or $10,000 or even $15,000 a year between two spouses for insurance premiums, you're saying it could be done with a lump sum deposit.
100%. We don't know if you ever need long-term care, but we're pretty sure you're going to die.
That's right. It has a death benefit. And the life insurance is the one type of insurance that always pays off eventually. Anthony will be right back. And we'll be right back with more here on the Income Generation. Stay with us. I know, of course, you're with family over the holidays, and I know you have at least one liberal in the family. Hopefully we don't get any smart aleck making rabbit ears behind you there while you're on television. Did that come from you, or is that just the people in our back room being extra anal retentive? Yeah, I notice even now I get my ankles swell a little bit more quickly than they did 20 years ago. It made me feel good that in my spare drawer I actually have my old flip phone still kicking around. The David type, oh, I like that one. I simply fired all my liberal friends. That's it, I got rid of them. Why is it I have to cuss on television just to read the title of your book, really? No, I have to confess, I haven't reviewed the entire tax plan. So you have to do me a favor and not say anything that makes me look silly or foolish about the tax plan. Is that fair? Can you do that for me? It's like asking you which one of your children's a favorite. I love it when you call me lad. That's perfect. It makes me feel young again. I like that. I know you could sing that there Acapulco stuff that, without the music. That was called Acapulco, I think it is, isn't it? Uranium. I think that's actually taken from Uranus. Isn't it the planet, Uranus? No. The 33-year trend in declining interest rates provided a... Yeah. It provided a following current. Welcome back to the Income Generation. We're still here somehow with Anthony Saccaro. He hasn't run out of the studio yet. President and founder of Providence Financial Insurance Services. Thanks for sticking around one last time.
Yeah, absolutely. And I got to tell you, the Retirement Income Store, the Generation, gave me this cake to give to you for your 100th birthday. I mean, your 100th show. So happy birthday.
Well, thank you very much. And as long as I don't take the cake to the face, you know what? Any cake not in the face is a good cake for me. So I shouldn't speak too soon. We still have a minute and a half left. Anthony, in the minute or so we have left, tell our viewers this. Most importantly, it's not about debt. It's not about asset allocation goals and all that. It's really about finding the right financial advisor that fits you, that can help you navigate through all this. What are your best words of wisdom for our Income Generation members about finding the right advisor?
Yeah, other than stay away from sugar, I think finding the right advisor really focuses on finding someone who is a fiduciary, someone who is acting in your best interest, not in the interest of the firm that they are working for. And unfortunately, you may not know, but most advisors work for a firm and get paid commission to recommend the products that they recommend. I think you really want to find an advisor that is sitting on your side of the table with you, representing you, and not the firm they work for.
And someone that's independent, can offer anything. How about generalist or specialist?
Oh, I think you go with a specialist. I mean, if you have cancer, you're not going to go to the generalist, you're going to go to the oncologist. And you want someone that specializes in your stage of retirement. If you're in the growth phase, find someone that specializes in growth. If you're in the income phase, find someone that specializes in income.
Anthony, one final thank you. I feel blessed to have you here in studio, in person with us on the anniversary of our 100th episode. And I'm blessed to have you with us also. Stay with us. We'll be right back here on the Income Generation. I'd like to thank both of our guests for joining us today for another episode of the Income Generation. That is the 100th episode. I'd also like to thank you, our new and returning viewers. I am relieved to say that we have not changed much since we aired our first episode of the Income Generation 100 episodes ago. In fact, by contrast, a lot has changed in the financial markets. And it continues to change almost by the minute as this new age of economic uncertainty just marches right on. A new presidency has brought new economic victories and concerns. The Federal Reserve's challenges with the new chairman in charge have only increased. Economic instability has increased abroad, and last year we saw a stock market reacting to it all of that with historical levels of volatility. In our time on the air, and with the help of expert guests like Steve Forbes, John Nigerian, Peter Marisi, and many others, we've worked to keep you up to speed on all these changes, as well as many others, and what they mean for you. We've done shows focusing on the election, the trade war, oil prices, the bond market, interest rates, the Fed, debt and bankruptcy, the changing face of retirement, and much, much more. And we hope to continue for at least another 100 episodes, our mission of bringing you the facts. Not hype, but just facts that matter to you, the Income Generation. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday.